All right, so for Group Three's TCA, we're covering the Uber versus Didi competition in China. This presentation will cover the issues Uber is facing in China, the loss of investors to Didi, and the financial market or financial losses in the Chinese market. We're also going to cover what Uber should do to fix these problems and what's next for Uber if they follow through. In August 2013, Uber entered the Chinese market to capitalize on demand, outgrowing supply in the digital taxi industry. Because at the time, the two largest taxi companies owned a combined 80.2% market share, Uber struggled to establish itself in the market and grow. On Valentine's Day 2015, these two companies were merged and claimed a massive 99.8% of the taxi hailing apps market. This led to Uber losing $1 billion by 2016. By fourth quarter 2013, there were two major taxi companies, Didi and Quadi, which had a 46.7% and 43.6% market share, respectively. By 2015, they had merged, claiming a 99.8% market share. This dominance led Uber to spend more and more money to try and keep up with this deep competition. Jane will now cover the strategic issue in the next slide.
Thank you, Tim. As Tim referred to, Uber is really struggling to gain financial ground on Didi in China, leaving them to lose around $1 billion every year. While Uber China is taking serious actions to try to catch their competition, they haven't been very successful in the past few years. The Uber CEO, Travis Kalanick, also stated that he's not quite sure how much investment it'll take for Uber to be profitable, showing that they believe they have a chance to be profitable, but they're not sure how much investment is required. While it's maybe an optimistic look on the situation, they acknowledge that they need to prioritize their profitability in China. Didi sets themselves apart from Uber China, though, by having specialized features such as on-demand bus services and the ability to test drive new cars on demand. If the issue is not addressed, Uber China could continue to lose money at this alarming rate, potentially losing their remaining position within China. Furthermore, Didi's position continues to grow stronger with additional funding from U.S. investors and companies, such as Apple, that invested $1 billion into them recently. As stated previously, the data provided within the case shows that Didi is continuously innovating their services, using the funds of various investors, and has continuous plans to expand into other countries, all while they maintain that 80.2% share of the market. In comparison to Didi, Uber China holds just 11.5% of the market share, while continuing to lose that $1 billion every year. Next, Tyler will talk about the indicators within Uber China.
Thanks, Jaden. Uber China is currently facing significant financial challenges with losses of $1 billion annually. To understand why this is happening, we need to understand the company's past in China. Uber entered China later than its competitors, leading to fierce competition to fight for market share and revenue. Excluding the taxi hailing market, Uber had taken close to 50% of the ride-hailing service market in China. However, the landscape shifted dramatically in 2015 when Didi and Quadi merged to form Didi and Quadi Joint Company, while their personal structures, business developments, brands, and operations remained unchanged. This left a newly formed company to dominate with 99.8% of China's taxi hailing apps market. This resulted in Uber's holding of the ride-sharing market share to plummet to 11.5%. The key financial and strategic quantitative indicators point to Uber's continued struggle in China. It is clear that due to China's late entrance into the market, along with fierce competition from rivals, that the future of Uber China isn't promising. Investing further in Uber China may not yield positive returns given how low Uber's market share is. The continued losses coupled with dwindling market share indicate that any additional capital could be gone to waste. Therefore, we believe that a strategic exit by selling Uber, which is currently valued at $7 billion, would be the best return on investment. Now Chen will talk about the external and internal forces.
Uber and Didi face external and internal forces that shape their operations in this market. Externally, technological advancements drive both companies to innovate. Uber leverages mobile technology and data analytics to enhance user experience, while Didi focuses on AI and electric vehicle integration to meet China's sustainability goals. Government regulation poses significant challenges, with Uber navigating varied legal landscapes that affect driver compensation and operational practices, while Didi deals with stringent oversight in China, impacting its expansion strategies. Additionally, fierce market competition compels both companies to continually adapt. Uber faces rivals like Lyft, while Didi competes against local platforms in a rapidly evolving market. Internally, organization culture, management structure, and financial resources further influence their strategies as Uber works to improve its corporate image and Didi leverages its centralized management for efficient operations. Together, these forces drive both companies to innovate and adapt in a highly competitive environment. Moving on to our analysis tools, our primary analysis tool is the VRIO framework. This framework effectively compares Uber and Didi by evaluating the resources across 4 dimensions: value, rarity, imitatability, and organization. It assesses the value provided through advanced technology and driver networks, highlighting their competitive advantages. Rarity is examined through Uber's global brand versus Didi's stronghold in China. Imitatability looks at the difficulty competitors face in the replicating resources. Uber's data analytics and brand loyalty are hard to imitate, while Didi's local partnerships create barriers for international entrances. Finally, VRIO evaluates how well each company is organized to leverage these resources, providing insights into their strengths and weaknesses in the competitive landscape. Our secondary analysis tool is the PESTLE framework. This framework analyzes external factors affecting both companies across 6 dimensions: political, economical, social, technological, environmental, and legal. This analysis reveals how macro environmental factors shape their strategies. For instance, Uber faces varied regulations globally, while Didi deals with strict oversight in China. Economic conditions impact pricing and profitability, while social trends influence service evolution. Technological advancements are crucial for competitiveness, and environmental considerations push both companies to explore electric vehicles. The PESTLE framework helps analysts identify strategic opportunities and challenges within their markets. Now I'll pass it over to Tim to go over the alternatives.
Thanks, Ron. Page 5 of the case states that Uber often offers cash bonuses to drivers who switch from competitors. This model could be expanded upon in China to drive away drivers from Didi. While this could hurt Uber financially, it could also cut into Didi's market share, which would hurt investor confidence in the company if successful. It may also convince some of Didi's investors to switch to Uber, filling their long empty coffers. It is stated in page 12 that Didi was able and willing to match Uber's services at a 40% lower rate. Uber must combat this by doing the same to Didi services. This would either force Didi into a price war that Uber could potentially win by drawing upon funds from other markets, or it will make Didi negotiate to come to a fair agreement that can satisfy both parties and restore some profit into Uber China. Lowering prices even further will also hurt financially, but it could also lead to Uber beating Didi's prices, which then would allow Uber to attract some of the cost-weary Chinese customer base. This could increase the demand in Uber's rides with lower commission that Uber takes. This would be a net benefit to everyone because the customer can save on taxi rides. Uber increases demand and will likely replenish their losses on rides, and investors win because it is seen that Uber is taking customers away from Didi. I'll now turn it over to Jaden and Tyler as they discuss implementation.
Thanks, Tim. As previously mentioned, Uber is currently losing $1 billion a year in China. As we compare the 3 alternatives, it's clear that the highest return on investment would be to sell Uber in China for $7 billion. To implement this plan, we recommend first keeping an eye on 2 key metrics. Perhaps the most important would be Uber's market share in the completed request market. Currently, they hold around 11.5% of that market. Secondly, would be to watch over the demand for ride-hailing services, which China has seen a 2.82% annual growth for the past 4 years. We expect this data point to continue to increase. If these two data points stay on pace, then we can reasonably expect to be able to sell Uber China for $7 billion. If Uber China is sold for $7 billion, then we would consider the implementation of our plan a success.
To implement our plan of leaving China as a whole, no new investments would be required. While Uber China is currently receiving additional funding for investments within China, it'll essentially be going towards a loss. Saudi Arabia recently invested 3.5 billion to increase Uber China's standing, but we would see that as a loss as it stands. As Uber China tries to increase their market share in the country, Didi is also continuously receiving further funds for investing, making it nearly impossible for Uber China to catch them. The next step would be to sell Uber China for around their valuation of $7 billion currently. Once again, we will continue to watch our key metrics to understand what the sales price would be. Once we receive the payments from the sale, we will look to invest this money elsewhere in the world. Again, looking into Saudi Arabia as a ride-sharing service for them. We recommend learning from Uber's past mistakes in China of entering the market too late and investing into an emerging area in the completed request market. In conclusion, Uber is struggling in China as they're currently losing 1 billion every year and only maintain an 11.5% share in the market. After reviewing all the data associated with Uber China, we found the best alternative is to leave the market as a whole, selling to Didi or another investor looking to enter into China's ride-sharing services. The analysts of Uber China showed that they were much weaker than Didi, especially in regards to Uber facing political scrutiny and regulations within the country. We recommend going forward that Uber looks to focus on markets that they could have first movers advantage within and adapting to the environment around that country, much different than they did in China.